Welcome to the Broken Pie Chart Podcast, episode 260. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, CEO of ZEGA Financial, Jay Pestrichelli. Jay, what's going on today?
You know, earlier, Derek, in the day, I thought I was going to be able to say another Friday, another all-time high. We didn't close there. We touched a new all-time high during the day, but Thursday closed at a new all-time high. So, look, I'm going to say the trend continues another week, another high. The market continues to move. It blew off some scary news like it was nobody's business, right? A decline on, what was it, Tuesday after CPI, and then it's okay. Recovery, new all-time high. Although Friday here, we did not close at the all-time high, but still another check mark. I'm putting it on the box, on the board. I told you last week I'm going to keep a board. Now I've got 4 in a row. I don't know if that's right or not, but that's what I got since I started tracking it.
Well, all right. Didn't I say that the market was going to be at 51.50 at the end of the week? So I lost this week's between you and I. Oh, no. You said it would get to 49.50. Yeah.
I said 4,900 or 51.50, and neither of those two things happened. I got very close at 49.20, did not get to 4,900. You said 51.50 before 4,900. I think that's so the jury's still out on this one.
Right.
It's leaning towards me.
Yeah, it wasn't in the next week. Okay. We didn't put ourselves into that pressure.
It was not in the next week. Remember, you just skated by on breaking the 5,000. You got 2 days above 5,000.
There's no skating.
You got it.
You either win or you lose. It's
why you use limit orders, Derek, right? Use a limit order. You hit your number, you buy and you sell. I used a limit order today, actually.
As did I. San Francisco 49ers got no trophy for being close. Let's just put it that way.
Oh, man, extra point. Okay, let's move on.
There's some game theory. Maybe if we have time later, we'll talk about game theory and NFL overtimes. I do want to talk about, so last week I made the case that maybe PE ratios or forward PE ratios are useless, Jay. And had some people.
You said you were going to be bold and be a contrarian.
I am still standing behind that.
Okay.
For the record, if this is accurate, we're at about 21.46 forward PE, meaning we're trading basically about 21.5 times forward earnings. The earnings next year over the next 4 quarters, 234.45 per share on the S&P 500. And, people say that's kind of high. And I looked at some charts and I was like, I don't know if it really matters if you buy when it's high or buy when it's low. But somebody said, hey, does PE really not matter? And I said, well, here's the way I look at it. You have to explain from 1 year to a next, or from the start of the decade to the end of the decade, if you want to do the attribution, meaning what caused the market to go up or down. Okay, well, earnings could go up or down, meaning, earnings per share on the S&P 500, or the multiple can change. Those are 2 things. And of course, within the earnings, if I want to get fancy, and I'm not going to do that right now, you could say, if they're buybacks, you reduce the share count. So the price could go up without earnings going up because the share count went down, and then you have dividends and all that stuff. So let's just, and the whole idea, Jay, if I set this up, if we have 1,000 shares and we make $2,000, okay, what's the earnings per share there? It's $2 per share.
$2, right? Yeah, $2 divided by, 2,000 divided by 1,000.
All right, so this is, and if the price of the stock, and we'll call it XYZ, our favorite stock, is 20, we'd say it's trading at 10 times earnings. 10 times $2 EPS is 20. All right, great. So let's say the price goes up to 30 from 20, and the earnings didn't change, the share counts didn't change, you still have the $2 EPS. Well, now we're trading at a trailing PE of 15 instead of 10. That's a 50% increase in the multiple. And by the way, that's a 50% increase in the price. So it's kind of an example of, if you want to explain how a market moves, the multiple can change or the earnings per share can change. I know we have other stuff below the surface, but, and Jay, we look at 2023 was interesting sort of example. Earnings were down a little under 1%. I mean, basically flat, but a little under 1%. And the total return, including dividends, was like 26.3%. So, I would say It's important, but just because it's at high levels doesn't mean it can remain at high levels. And Jay, you've always made the point that it's the forward things that market looks at. They're forward looking.
Yeah, I mean that it's the market's always ahead on this stuff. And so you're right. So last year earnings were flat to down, but the market was up 26%. So you'd be like, okay, so the market doesn't care about earnings. Yeah, but the year before, when the market was down 18%, it was, I would theorize it was projecting that earnings were going to be down. Then you do the next skew, like the earnings of 2022 were up 12%. The market in 2021 was up 28%, right? So I do think that there's something to be said here about kind of the projected, the nature of, what the market does ahead of those earnings happening. I'm just, if you put these off, Derek would be interested to put these off just, not right now, but put these off on like a 1 year skew and look at the difference. And I think you'll definitely see a higher correlation. But you're right. That last year, earnings are flat, market roared, and it's still roaring. So what is it telling you about earnings for 2024 with what the market is doing early this year? It's
I
probably
mean,
it's optimistic, no?
yeah, I mean, earnings are projected to grow about 5.9%. So I think that and also interest rates, we can set that off aside. But yeah, I mean, it's looking at 5.9% growth next 4 quarters, and the next from quarter 5 through 8, it's like plus 12.86. Analyst estimates, they can change. But yeah, it's forward looking for sure.
Yeah. Okay.
All
There it
right,
is,
that's
forward
it.
looking.
You got nothing
That's it.
else? That's
Listen, earnings still matter, everybody. Like, don't think they don't matter. I think you were just saying the timing of earnings can be a
Well,
little
the
skewed.
forward
And the other
valuations,
thing is,
yeah,
yeah,
the forward PE ratio
yeah.
is, I think it's overrated we're overbought. I mean, it, yeah, of course, if you buy, all right, let's set that aside. I think we beat that up enough. You want to get crazy, Jay? Let's get a little crazy with,
Let's get crazy. Let's build. Let's Michael Keaton. Let's get crazy. Let's do it.
no, that was Costanza, wasn't it?
No, doesn't he say when he's Batman and he's saying it to the Joker? You want to get crazy? Let's get crazy. No, okay.
I think it was, no, you're probably right, but Costanza does it too. You want to get
Yeah,
crazy? Let's get crazy. All
that's
right,
true. A little
skew,
Seinfeld there. Skew. Oh boy.
skew. All right, let's do it. Let's go there.
All right,
So,
Professor. What is skew?
so if you think about the shape of a smile and you imagine what's the implied volatility of puts on the left side and what's the implied volatility of calls on the right side. And we say skew or the smile because you say if out of the money puts and out of the money calls have the same implied volatility and just saying, how much premium or how much movement is baked into those, they would be symmetrical. Usually, Jay, puts have higher volatility in the premiums than calls do. So somebody had sent me this chart, and I think it's meant to scare people. And they had in big prominent letters, February 2008, Volmageddon. And the point that they're making is the difference in the 25 delta out of the money put implied volatility minus the 25 delta implied volatility of the call side is getting pretty low. It's I think it's 1.44, meaning the difference. And they're making the case that, hey, it hasn't been this low since Volmageddon, and that's where some VIX ETFs went, or VIX ETNs basically went poof because the VIX futures doubled, and there was some upset in the market. So let me kind of stop there. I like to let you also clean it up or give your own
Yeah,
spin on
so
this.
normally this number, right, when you look at puts versus calls, the implied volatility. So puts typically have higher implied volatility. Why? Why are people willing to pay more for puts? Well, there could be a lot of reasons, but the main one is people are putting on protection, right? And by people's, it's actually institutions just as much as individual traders. So of course there's speculation to the downside. That's fine. That people will, short-term trade puts. with a limit order. Somebody might have done that recently. We might have talked about that earlier. So, but puts in general are more expensive. And so the point of using implied volatility that tells you how much people are willing to pay for the directional move, right? Puts are a bearish move. So if you're willing to pay more for a put, great. The other side of it here with a call, when calls start to increase their implied volatility, well, that means that people are more optimistic about the market. They're willing to pay more for calls. Now, we are in a little, an environment where calls are cost a little more than they historically do for interest rates, and we've talked about that in the past. So, what this is telling you that the difference between the put speculation and the call speculation has narrowed to the point where they're almost kind of even, like a 1.4 difference between the implied volatility on the put and the call. So there's two ways that this can happen. It's the difference between the two. So either call IV went up or put IV went down, or a little bit of both. And right now it's a little bit of both. You've got the VIX low, volatility in general is low. You've got interest rates, so implied volatility on puts dropping. You've got interest rates which are higher, which drives the call implied volatility higher. So you've got some pieces there. You've also got a market that's ripping to new highs. And so you have traders that might be selling puts for income, right? In that scenario, which also drives down the IV. Or you have speculators that are saying, the trend is my friend. I'm going to buy more. I need the calls will begin to be more expensive as the market continues to press through new highs. We're not even going to talk about a gamma squeeze. I think there's just a lot of things that are moving around here that are causing this chart to say, look, the difference between how expensive puts are and calls are have really never been this low, except for one really scary time in 2018 called Volmageddon. And that really only impacted a small portion of the market. It caused a little bit of a market oscillation for maybe like a week. And then, February was back on track in 2018. But yeah, so this is like a weird situation that's supposed to, set off some alarm bells. But 2018 is not comparable to what is happening in 2024 because the situations are very different. However, this is a stark difference. Like, this chart is moving. I'm not saying it can't get, it's over and they'll have a reversal. So yeah, that's really the question here, Derek. So what does this mean? So if you were going to get a reversal of this put call implied volatility skew, meaning the puts ended up being more expensive than the calls, what are the ways that could happen? Like, let's talk about the ways that puts can increase in value compared to the cost of calls. What would you say would be the number one reason for that?
Well, I mean, just look at supply and demand, right? I mean, if the demand for put goes up relative to calls, and I would say if we get a little upset in the market, it doesn't have to be a major thing, but I think, the demand for insurance goes up, right?
Exactly, right. And so we all call not we, a lot of people call the VIX index the fear index. Well, when that spikes, it's because volatility is spiking in option pricing. And that can go up when there are calls, but it really goes up when puts, well, there's dynamics here, but when puts get more expensive, that's usually an indicator of fear and usually means the market is going down. So that would be a way that this number would return back to normal, where put volatility would go up. And another way this difference could happen is call volatility could drop. Two ways that'll happen. Interest rates can go down. We talked about that earlier. Or there's just a lot of folks that don't take a complete bearish position. They're willing to just sell calls at this level, take advantage of it. I'm going to tell you something. Before we got on the podcast here, we were looking at one of the trades, Derek. This is, I'm throwing you a curveball. We were looking at the high probability option strategy that we run, our aggressive version. We were looking at selling calls on the rut, right? We're already in short puts that we got in earlier. This is one of the strategies we run. It's the high probability option strategy, aggressive style. Some of you may know it. Some of you may have a love-hate relationship with it, as as anybody that's been in a while will attest to. But Derek, 13% out of the money puts for 3 weeks meet our entry criteria. 13% out of the money for 3 weeks on the run. That is expensive for calls, meaning the market is projecting a higher numbers than where we're looking at than it would normally look at. Like I was floored to see a 13% out of the money call spread meeting our rules. So I do think that part of the reason here is calls are getting a bid. So I don't think the puts are getting, the market is getting sanguine. I think calls are getting a bid. So I think one way this returns back to normal is that people sell more calls and calm down all of the speculation that's here on the upside. But there's quite a bit of speculation on the upside. We're seeing it all over the place in the options.
Yeah, I mean, put some color on this. I think this said it was the 1 month, right? Yeah. So if I
Yeah.
look at the 1 month out SPX option chain, to just throw so everybody knows what 25 delta means, it's about, for the put side, about 2.3% below the market are the option strikes that this is referring to. So today that would be about 48.90, and we closed at 5,005.57. And then for calls, it'd be about the 5120s, also 2.3% out of the money. And that kind of shows the symmetricalness of this right now.
Yeah, the
smile.
thing that's great about this, we talked about collars last week a little bit with our Gen Zers. If you're looking for a costless collar, you have upside downside being equal 1 month out. It doesn't happen all that often. It really doesn't. And I think a lot of it, Derek, is because calls are more expensive than they normally are.
They are.
Yep. It's not that puts are cheap. I think just calls are more expensive. Puts are cheap, by the way. It's both.
Yeah, no, it is both. And I also think it also goes into, if you're a market maker and you think about it, if somebody is buying a call from me and I'm a market maker, I'm selling a call to somebody else. And then I have to do what? I have to buy shares of stock to hedge. But it's almost like, imagine if you were a store owner and you're like, hey, all these people are buying apples. And, usually oranges are much more expensive and apples are cheaper. Everyone's buying apples. I want to slow the people buying, the rate of people buying apples. I'll raise the price. It's kind of one of those things. So in a weird way too, it might be on the market maker side from their books and their inventory being like, all right, if people want calls, you're going to pay up for them right now because they're in demand. So totally unofficial, unsubstantiated view of that, but that's kind of the way I look at it.
Yeah. All right. Well, we're in interesting times. These are the things that all kind of happen when you get, I'll say a prolonged directional move. And this move up has been since what? The beginning of November. So you've got November, December, January.
It's like 10.5% since November. Yeah.
I think it's more. Yeah. So it's
could be.
Yeah. We're at the, 3.5 months of just one direction. You start to, things will. Well, I don't want to make any predictions here, but I took the 4,900 and you took the 5,150. So there you go.
Yeah. Yeah. I think the best thing too is, and this is good. So we talk about stuff all the time. I always remind the audience, like we were just showing an example of a trade. We're not giving recommendations here. Like the core thing we do is we buy, we hedge. Derek.Moore at ZEGAFinancial.com if you want to know more about how we run portfolios, but like these are all kind of examples. So, all right, Jay, let's switch to correlation and dollar index versus, let's say, the S&P 500 index. This has been something that I watched for a long time. You brought it up recently, but let me let you start on this one.
Okay, so one of the things we've talked about are what are the things that are potentially driving this market, right? And I happened to look, and in the past, we talked a lot about how does the dollar impact, the value of equities. And, Derek, you've always had a great perspective on this, but if you look since, the beginning of this year, the dollar index has been on the rise. and so has the equity market. And so I know we talked about equity started in more like November, but if you look at January in the dollar index, it's up, I don't know, from 101 to 105, touch 105. It's been kind of trending up recently, and I just wanted to bring this to light and see like if you could see more of a correlation as to where we are. In previous years, we've definitely seen a higher correlation between these, and then some years they're exactly opposite. So right now, it feels like we've got correlation on this, Derek. No?
Yeah, no, they are more correlated, and it's very different because if you look at 2021, towards the end of 21, the very highs in the market, the dollar index was much lower, and it was coming off a lower. If we look at September of 2022, the very lows of the market, so probably September, October, were at the highs for the dollar index. But I would agree, I also feel like, Jay, there's this indifference area where once the dollar index gets above a certain level, then it starts to matter. I don't know. You're right though. They're moving up together, and I wouldn't expect that if I would say, because I kept saying, in order for the markets to go up, the dollar has to go lower. But yeah, Jay, it's a little more correlated right now.
A little correlated, kind of like how bonds are kind of correlated to the equity markets as well. Like they all kind of fall into the same category when you start to look at some of these charts just today, right? I mean, just now, like
Yeah,
the last few months, right? That's not always the case, but we're in this like kind of regime where everything is starting to look a little more correlated, which means when it all unwinds, could also unwind together at the same time. Yeah.
yeah. I mean, I can't tell you how many people, and I was in the camp too. I thought the dollar would be much lower. So, by the way, the dollar index is just a collection of, it's a basket of currencies against the US dollar. And the dollar index, the normal dollar index, it's very Eurocentric. It's the euro, it's the pound, also the Japanese yen, probably 10, 11% from memory makes up that. And there's also a trade weighted US dollar index, which is weighted based upon all our trading partners. But yeah, I mean, I also think maybe it's the dollar index is sort of coincidental right now, and it goes back to rates, where this market is really priced in for lower inflation, lower rates, and if you get lower rates, the dollar index should decline as it gets, it's relative to other currencies. But yeah, I mean, and Jay, I always remind people, I'll ask you the question: why is a lower dollar better for U.S. global multinational companies? By the way, like Microsoft and Apple and a lot of people, right?
Yeah, well, it's better because when they sell they sell their widgets overseas. Everyone uses widgets in this example. They sell their
Mm-hmm.
widgets overseas. When those euros, or you could pick one of the crazy currencies you like to talk about the loonie quite often. I think
Canada,
you
yeah,
yeah, it converts to more dollars as it comes back to the United States, and that's one of those things where just we report earnings in dollars. So when you sell in euros and you get more dollars because the dollar is weaker, then guess what? You make more money selling the same thing with the same cost. But that's why it usually helps. But it's weird when they're both going up together. You would think it would be detrimental to earnings, but not in this case. Not what's going on right now.
it's just there's so much margin in chips, semiconductors. I guess it doesn't matter, Jay.
It's all about Nvidia.
I mean, right? The 21st, so that's next week. That's
We'll be talking about Nvidia next week, I'm
I
sure.
know. I'm trying to think. So AMD, did they disappoint a little bit, or they guided? I mean, AMD has been on a rocket ship too, for sure. There's the SOX index has been up. That's the semiconductor index. So, and look, I mean, Nvidia is a pretty big percent of the S&P right now. So that's the great thing about it. The S&P 500. I know everyone keeps complaining about, oh, we have 5 or 10 or 7 stocks that make up most of the S&P, but this stuff changes. It was like, what did we say? 20 or in 1980s, it was Xerox, IBM, and AT&T and T and Exxon, and those companies are no longer in there. I mean, they're in there, but they're not weighted as high.
Have the index make the decisions for you. You don't have to pick the winners. The process will do it for you. Exactly.
All right, Jay, this is an exciting moment in the podcast. And the reason why I get to talk Japan. Yep, it's happening. And the reason is Japan, their quarterly GDP percent is in a technical recession. So 2 quarters in a row of negative GDP growth. Congratulations, Japan. Now, Jay, this is why things are so tough to predict. If I told you ahead of time with great certainty, in fact, imagine I time traveled and knew the Japan will be in a recession in Q4 and Q3, and I had that information and gave it to you. What would you do with the Nikkei index, Japan's?
Well, I certainly wouldn't want to own stocks. I'd sell it. I might even short it if I knew there was going to be, recession. No,
And
isn't that what we all do when we hear recession?
you would have lost your house. No, the Nikkei is right around all-time highs. In fact, it's so strong right now, we're approaching the 1988, 89 area all-time highs.
I mean, it's great. Like when I saw you put this together, I was like, wait a minute, I just heard that they hit all-time highs. You're telling me that they're in a recession and their market is, showing really no signs of slowing. It's been on the move higher, gosh, for years, right? I mean, of course, you got your ups and downs, but since 2013, the Nikkei has been moving up higher. And yeah, that's nice that you reference the high in the 80s. It's one of those scenarios where it's not what the U.S. market does, right? Where you buy and you hold and you hedge and you could be in it for the long term because markets typically make new highs or go higher. That Japan has been troubled for a long time getting through this. So it's really kind of amazing that it's I didn't ask this of you earlier, but they're finally getting some inflation, right? They've always been fighting a deflationary fight. So they're finally getting some inflation. Their bond yields are starting to tick up. It's almost like their economy is returning to some normalcy from when it, just completely got out of whack, right?
Yeah, I mean, the argument has been for a long time that Japan, by keeping their rates at zero or less than zero, actually stymied growth. It has sort of the reverse effect. Like when you have interest rates below the natural rate of interest, it's actually problematic. So yeah, I agree. I mean, and it's the same case we made in the 90s. I mean, the US was 5% Fed funds rate and the markets did just fine. You don't need zero rates for the markets to do okay. And in Japan's case, Jay, I would, if I was an attorney, I would say you open the door there for more questioning, and I would go on a 1 hour presentation about the history of Japan and interest rates. I won't do that, of course,
I was going to
but
say I might be out that week.
well, no, I was going to do it now, right
No,
now.
I'd be out this week. Then I'm
No,
out.
you'd hang up. Okay.
I already did it. I'm busy this week. I'm not. Oh yeah, sorry.
Their policy rate, though, is still, I think it's 0.10%.
10 bips, I think. Yes.
So just
Yeah.
slightly negative, less than zero. Their overnight rate is basically zero. But their futures, their implied future rate, Jay, this is interesting. By March, 0.03%. So,
Wow, crazy.
But yeah,
Which,
go
by the
figure.
way, is can I just bring this up? Like, why we still watch this, right? Like, so Japanese investors tend to invest in other countries' markets, right? So, in order to do this, what do they got to do? They have to convert their yen to dollars, right? Or wherever they're going to invest, right? Because they're not getting a yield at home, right? Domestically. So, a lot of times people will see that you watch what happens with the yen, whether investors are selling their foreign investments, and that which eventually turns, they got to go back into yen, or they're buying foreign investments, which means the yen is, going down because they're selling their yen and buying other currencies to buy external indices. So it's one of those things that you've heard. You have to kind of connect the dots here while you've heard the yen is a safe haven. it typically indicates when money's flowing into the yen and the yen is going higher that Japanese investors are onshoring investing dollars back into their bank accounts, taking it out of external markets. So it's just, we talked about Japan. I just thought I'd bring that point up, why people think the yen is a safe haven. It's not always obvious because you got to connect a few dots there. This being one of the dots saying, look, you're not getting paid anything on your money in Japan, right? That's the idea there. So they go external.
Yeah, and it goes to demand for treasuries. It goes to, there's any number of things. Their currency, by the way, it's about 150. And the way you do currencies is when two are listed, it's, so for example, it's USD for US dollar / JPY for Japanese yen. And when you see 150, the one that's listed second, the number refers to how many of the second do you need to get one of the first. So you need 150 yen to get one US dollar right now. And so when that goes higher, it means the yen is getting weaker. And, the yen it could get weaker here if they keep rates down. We'll see. We'll see if they want to do that or not. But all right, I pushed my luck with a couple minutes on Japan. I slipped in cocoa futures last week. We'll see what I can slip in this week. Jay, I want to bring it back to our own markets. And then we got to talk about volatility. But before I do that, a couple things. There's the general theme right now is rates will be lower, inflation will be lower, and continue to trend in that way, right? That's the overall. Wouldn't you agree? Overall consensus.
It's generally the idea. That's yep. Yes, I agree.
All right, so let me bring this to you first. This is the premium or insurance premiums, motor vehicle insurance, U.S. urban consumers, non-seasonally adjusted CPI. So this is how much does insurance premiums rise year over year? Congratulations, U.S. auto drivers, 20.6% was the year over year increase in insurance. Last year it was 20%. And so, this is the type of stuff that lags. And by lag, I mean, you're not re-upping your car insurance or your home insurance or whatever insurance every month. So it's like, oh, a year later, your policy comes up. Oh, congratulations, it's 20% higher. So I bring this up, Jay, because there's all these little things on the periphery that are still feeling the effects of higher inflation.
Well, and that's if there's something we learned this week, right, between CPI and PPI, inflation is the data point that, still drives the market. Like, I don't love, when we talk about a single data point is a single, characteristic of the market is the binary factor, but that seems to be the case. It's inflation. We get PCE, which is the inflationary measurement that the Fed uses. We get that next Friday. Am I right about that? I could be. Yeah,
I think so. I think somewhere around there.
Anyway, that data point is going to be the one that really matters. But the CPI and PPI that we got this week usually are an indicator of which way the market is going to go based on that. So look, I mean, I think if there's one thing that the market is afraid of, is that the Fed has to leave rates higher for longer. I think the market was a little aggressive coming into the year, expecting 6 rate cuts. I don't think either of us thought that was possible. CPI now remaining a little higher this week. PPI coming in a little hotter. CPI a little hotter. Tells us, maybe they're not going to cut so much. So I think it's important to watch the inflation number because it will drive the Fed action and tell us if they have to continue to leave rates where they are to still try to cool the market down, because the market's still hot. It's clear. Inflation is not licked. I know we don't have 10% inflation, but it's not at their 2% target.
No, it's not. And, oil has been rather subdued. We've seen oil actually, it's probably at the highest level it's been since November of last year. If I look at a West Texas Intermediate, WTI, future. Yeah, it's that's if we get a repositioning of oil higher, You and I won't get into container shipping because don't want to push my luck at how much I bring that up, but container shipping costs are up higher because of the stuff in the Red Sea and the Suez Canal. I don't think it's too much to say that impacts the inflation. So, oil prices, shipping cost, those all matter. And I think there's some risk there. Where we've seen inflation coming down, though, is, shelter is of the CPI, it's roughly, I should have looked this up before the broadcast, Jay. It's probably 45% of CPI. And it's at least that or more of core. And so the shelter cost, and you're like, what do you mean by shelter? Well, there's rent. So how much does it cost to rent a place? There's something called lodging away from home. That's hotels, things like that. And then there's owner's equivalent rent, which basically is a way, that's the methodology, and they've done this since the early 80s. They do a survey. They call homeowners, and it's kind of, I'm just going to generalize this. Hey, if you had to rent your home, what would you rent it for? So those are the ways they look at this. It's 6% year over year, the total shelter complex. I would say it peaked out in, I'd say, April of 23, and it's been trending lower, which is good. The thing that I guess, owner's equivalent rent is about 4.6% year over year. Rent is about 1.3% year over year. And I don't know. I mean, our argument, use my words first. You can tell me if you agree with this. The longer the Fed keeps rates high, the more pressure there is on some of this rent and owner's equivalent rent, because if you're a homeowner, you're buying a home, your mortgage costs are higher. But people own property and they're paying servicing costs, and then they have to, people are renting. So I think it's actually higher rates are putting pressure. They're not easing those rents. But
yeah, in this world, we've talked about this multiple times, right? In this world, it's you almost get the inverse adverse, whichever way effect that the Fed is causing by keeping rents higher. So while you're slowing down the real estate market, you're also increasing the cost in the real estate market, which is why you've slowed it down. It's weird. It is a weird dynamic here, right? So, like Derek, I think it's going in the right way. This is, the shelter has always been kind of the part that we thought was not accurately reflected in the CPI numbers. I think it is the one thing that is weighted very differently in the PCE versus CPI. I can't remember exactly what that was, but I heard that this week. So it's important to watch this, Derek, but it is going in the correct direction, but it's still high. It is still high.
Oh, it is. It is. It's still high, but yeah. And there's going to be a lag too, because the way this works is you're not just picking people who are newly renting today. You're looking at the rents, and they sort of have an amalgamation of, people who have 6 months left, people have, I won't get into it. I'm going to bore the three people who are left listening. But yeah, I mean, it's a little sticky, a little laggy, a little sticky. And, so I think, by the way, shelter accounts for a third of PCE or a third of CPI. I think it's more of PCE, but I could be wrong on that. Could be wrong on a lot of things. That would be one of them. But
I don't know the answer.
All right, Jay, let's switch it to VIX. Like, really, VIX? That's all you got? Go to 18 for a day, right around just south of 18, and no, we're back today down to 14 and a quarter. All good, right?
And it's been a lot of the day below 14, by the way. Yeah. So back to the the low regime message. Like, it's this. We talked about volatility when we talked about skew. We'll talk about it again. It is hovering and staying low. Like it almost peaked above 18 intraday. I think it still closed at 16, Derek. I don't think it closed at 18, right? When we had the little bit of now I got to look. When we had that little bit of a sell-off, yeah, that day it closed. Oh, not even 16, 15.8. Now that is the highest it's been since it was coming down in November after the sell-off in October. But look, I mean, there's a little trend up, right? The lows are a little higher, the highs are a little higher, but the VIX is still not, no alarm bells going off here. Like, you got to get above 16 for us to really consider it anything, right? And I think 20 is more notable, but still low. VIX still low.
Don't you think this is one of the frustrations for a lot of people where they say, well, the VIX is low, it's got to, I'm going to buy it now because it's low. And Jay, I mean, it's not the case.
I mean, people will people will use the VIX as kind of a contrarian indicator, like, oh, low VIX, that means the market's, the law of the crowd is wrong. Well, they haven't been wrong for a long time. Like, the VIX dropped below 14 back on, November 20th or so, and it's pretty much stayed below with the exception of a handful of days. Tuesday being one of them. I could see like maybe 3 or 4 other days where we closed above 14. So if you were a buyer of volatility because you thought the VIX was a contrarian indicator, you've been wrong for months. The VIX can be, low for a while, right? When you look at, I'm thinking about this, Stark, the volatility of the market of what's projected versus what's been experienced. So even though the VIX right now is 14, the actual volatility experienced, and this includes Tuesday, has been less than 12. So at 14, Derek, I could make the argument that it's higher than it's more expensive than it should be, even here. So, the beginning of the year, like where we ended the year, like the 30, and this is just, it's a 20-day number. I should probably look at a 30-day number, but the 20-day number was like a 10, meaning a 10 vol, meaning not a lot of volatility in the market. That's a low volatility, everybody. A 10 volatility is low. So when the VIX is at 10, right, that is a very extreme. We really didn't see a lot of that except for 2017. So it's one of those things where even though the VIX is a 14, Derek, it's still more expensive than what has actually occurred, the volatility of the market itself.
What day was that it went to 18? I downloaded the skew data. Let me see if I actually have that day in the. Was that the 14th? It was, wasn't it?
It was Tuesday, which would have been 11th or 13th, I believe.
I don't have the 13th. Darn it. I have up to the 12th on my. I was going to do it live. Look at the skew.
Oh, on your no. It was February 13th for you.
All right.
And it didn't get to 18, by the way. It almost got there.
It almost
17.9 something. Yeah.
Well, close enough for government work, but yeah,
well,
it's
or this podcast. Either way.
Yeah, I mean, we'll round up, round down, whatever makes more sense. So, yeah, I don't know. I mean, I'm trying to think if there's any connection with the skew and the VIX, and maybe, and I think it goes to your point. Maybe the VIX or the S&P puts are where they ought to be or where they normally would be, and maybe it's just the calls have risen. Because you would think that the skew would change a lot more, or if it's very close. I don't know. I'm thinking out loud. I'll run some numbers on that. Jay, what about the VVIX? What's going on there?
Okay, so the VVIX, this is the implied volatility of the VIX index, right? So there you have a VIX, right, which is we talked about, which is the implied volatility of the market. There's actually options on that index itself. So you could buy and sell puts and calls on the VIX if you have a directional bias. Buyer beware on that. Tough to trade the VIX.
Don't do that, folks. Don't do it at home. Yeah.
Derek and I paid a lot of tuition trading the VIX. We'll leave it at that. Anyway, it doesn't mean we don't do it despite our education. I would say, but the VVIX is the index that shows us the volatility on the VIX options themselves, right? How much people are willing to pay for movement in the VIX index. And so that has also been kind of hovering in the low 80s. We saw a little pop on Tuesday. But so when the VIX is in the VVIX is in the 80s, again, it says that, buying VIX or the price of VIX options themselves are kind of on the low end, right? An 80 implied volatility on the VIX. So it's Derek, it's not really it's not compressing, it's not telling us too much, except that the options are cheap on the VIX. And you'd think that was also a contrarian indicator, right? When people aren't even willing to use the VIX to pay up for protection, that just everybody is just not feeling any fear. But that's what's happening. Like, they're not willing to pay up. Like, you're not paying a lot of money to get to buy the VIX options, the VIX 30. So I think everybody, the standard spot you go to when you want to buy a VIX option is the 30, right? Everybody says, oh, if the VIX really spikes, I want to look at the cost of the 30 strike option, because that's kind of a spot where the VIX kind of gets to from time to time, right? When things are really fearful. We saw that in early last year, right? In March, we saw the VIX almost got to 30. So, I'm looking at the VIX option chain right now, Derek, on the fly, and like, there's not a lot of open interest across the board. I'm almost feeling like I'm looking at the wrong darn open interest. I mean, not till you get to the March 13th options do you see any real volume. And when I look at the 30 strike, which is the one I just mentioned, yeah, it's got 147,000 contracts there, and it's the biggest one. It's because where everybody goes. But, it's still relatively cheap, 25 cents to buy that option. I'm not telling people to buy it, because in order for that to really pay off, the market has to get above 30. The VIX has to get above 30 and stay there for a while. But yeah, cheap. VIX options are cheap.
And call options are expensive on the Russell 2000.
Wow. Well, so what do we do with that? We're what?
I mean, we were messaging internally, and I think one of our our head of trading, Mick Brokaw, made the point. Russell was down, what, 4 or 5% in that one day on that sell-off?
It was down over 5 at one point. Yep. Closed down 4 that day.
And that was versus the S&P was down at that point, down about 1.75, right? So
Yep.
more than, that's a little bit of a ratio there, which has some interesting tangents on itself. But yeah, like, you would think, okay, so imagine this. It's not quite the same as all-time highs while you're in a recession, but you'd say, oh yeah, at the very point that the index is selling off, the calls are sort of richly priced relative to puts. Like, how does it even make sense? You think everyone was piling into puts, but no, it's not. All
okay.
Right. That's it. We'll leave it there. Any recommendations?
Okay.
No, that's it. You got nothing on the rod? All right. Well, we'll save it.
I told you we're looking at it. We'll see what happens with the rut. I don't know. We'll.
All right. We don't want to give too much away,
right?
nor give any recommendations. Right. So there you go. Yeah, not a recommendation.
Not that recommendation.
Do your own research, and if you want to buy the Nikkei index, you buy the Japan index. If you don't, you don't. Recommendations, Jay.
All right. Well, I watched one of the Marvel movies that came out. I think I like the Marvel stuff. You're kind of quasi. You do it, you don't do it. It was okay. It was the Marvels. It was not great. So not a great recommendation there. I wish I had something good for you, Derek, this week. I was at a conference. Oh, you know what? I could recommend Miami. I was at the ETF conference all week in Miami, and Miami's still a great place to go in February. Of course, I live in Florida, so it's not that much of an improvement for me. But good time. I would tell you, I don't know if you want me to tell you this, but that conference really focused a lot of focus on, Bitcoin being allowed, spot Bitcoin being allowed to be held in ETF. So a lot of discussion about that. You know what there was no discussion about? International. Nobody was talking about international investing at all. Not a single session even touched on adding international to your portfolio. So, maybe that's something to think about, right? All the pomp around crypto. No one's talking international. I guess we'll see that reversal when it comes. Interesting that you brought up Japan, right? Nobody even brought it up. So I don't know. I would say Miami was still a good time. Super Bowl was boring for most of it. So, and not even my most favorite game either. I don't know. Nothing great. I guess I'm blah this week. What do you got?
No, I do like Miami, and at least you gave. It's not like Mike Puck, who recommended an air conditioning repair place in Miami that are Belgian and Norwegian listeners, and we got some listeners around the world, so they can go to Miami. It's
if
a
you go
good
to
place.
Miami, the Fontainebleau is where the conference was. Great place. Long history and reputation at the Fontainebleau.
They just opened a new one in Vegas, didn't they?
Yep, they did.
That's the original though, the Miami one.
It is in South Beach. Well, no, it's just Miami Beach. It's not really South Beach. It's still too far north, and it's not North Beach, so it's just Miami Beach.
By the way, I'm writing this down. I don't know where I'm going to put it. I'll put it on a scrap piece of paper. But contrarian / international ? No one's talking about it.
No one's talking about it.
File that away. More on that. It's it's an exchange traded product or exchange, an ETF conference, but you're saying it really focused on Bitcoin. That's the big thing. Okay. All right. I mean, is there that much interest in Bitcoin ETFs? I don't know.
Yep.
I mean, are the dollars showing it though? I mean, are they really coming in?
Yep.
Okay. All right.
Sorry. Look, I didn't even bring any guests, and I didn't even want to bring it up. But I'll sneak a Bitcoin advocate on the next time we got someone coming in.
Well, I'll look forward to that.
Love when that happens. I know.
It's all right. I'm going to be curious to see how much money actually goes into these Bitcoin ETFs. Isn't it all just coming out of the one that was the Grayscale? Isn't it just coming out of there?
Well, there is plenty coming out of Grayscale, right? Because of fees. Maybe we don't want to get into all that, but yes, there is money moving around, but there is absolutely money flowing into it. So, I actually got to meet Michael Saylor on this trip. If you know who Michael Saylor is, he's the CEO of MicroStrategies. Huge advocate for Bitcoin. We got to talk to him about his outlook. It'd be great. Maybe he would come on the show one time. We'll see if I should have handed him, your card. Call Derek, come on this wonderful show and debate the merits of cryptocurrency and Bitcoin.
Look, I love talking to people who I have a different position on, because if it's a good discussion and you're asking the right questions and it's a good dialogue, yeah, absolutely. I've been wrong tons of times. Clearly, me not liking Bitcoin, and I didn't like it at 20,000. I don't like it at 50,000. So I have no idea where this thing's going. I have my opinions on it, but yeah, I'd love to have him on. So, all right. But Miami, I'm bullish on mango juice, by the way, Jay, in Miami.
You mentioned that, how much you liked it last time you were in Miami.
I tell you, there's something about, yeah, I like.
All right, I'm going to send you some mangoes, buddy. There's mangoes all over my neighborhood. I'm going to send you.
Do you have like the yellow ones or the red? What do they get when they're
yellow?
Red?
Yeah, they're like yellow.
Oh, yellow. Okay. All right. I'm interested. Orangey. Yeah. I'm in. My recommendation this week. So I'm going to watch the final episode of True Detective season 4. I think it comes out. What is it? We're recording on Friday. It comes out tonight. It's more like horror / not necessarily horror, but sci-fi. I talked about that last week, but so far I'd have enjoyed it, but I don't know. I think I'm the only one watching it. No one else has even talked about it with me. So we'll see what happens there. And F1 doesn't start till next week, Jay. So that will be
okay.
That's a little. Oh, I know what I wanted to. So you were off the podcast that week, and I wanted to make sure you got this recommendation. Not like I don't talk to you outside of the podcast, but Society of Snow. It's a docudrama on Netflix about the Chilean, the Uruguayan rugby team who went down in the Chilean mountains in 1972.
Society of Snow. Got it.
Society of Snow. Yeah, I'm pounding the table on that.
Okay.
So,
okay.
All right, that's it, Jay. That's all I got. Let's end this here.
Yeah, I wish we could be. Let's see. Maybe we'll have a little more fear next week, and we'll see what happens.
Should we scare people? Do we scare people or encourage people this week?
You threw out the CPI numbers. You threw out the Volatility thing. We're talking about put skew and calls. It's,
Maybe I can.
you're catching.
Well, we either confused, scared, or made people happy. Either one. Markets go up over the time, though. It's
They
okay.
do. It's why I got this board with all-time highs being checked off. Did
Keep
you know,
checking.
Derek?
Yeah.
36% of the time the market is within 3% of an all-time high. Think about that.
I mean, imagine
Over a
if
third of the
everybody
time.
who was like, "Oh, we're getting close to an all-time high. I should go to cash." Like, imagine if that was the reaction. Like,
Yeah, that would be. It's very normal to be near an all-time high. It is.
you'd just be in cash. All right, that's it, Jay. I'm calling it. See ya.
All right.
Take
Bye,
care,
Derek.
everyone. Bye.